So many people criticize traders that use technical indicators because they lag. And a lot of people will always say to just watch the price action or to use a completely blank chart because the only thing that doesn't lag is the price. Well, this point they make is totally a valid thing to say, but it's not necessarily 100% true or the most useful piece of advice, I'd say. I know from experience that technical indicators that lag actually have great use cases for developing trade ideas and just to use within a strategy. Some of the best price action traders actually use stuff like the 200 daily moving average alongside their price action analysis, just as an example. And the one thing that most of these people who criticize lagging indicators don't ever mention is the fact that there are actually indicators out there that are considered leading. And these leading indicators aren't repainting or delayed or anything like that. They simply just have a different use case. So guys, in this video, I'm going to cover 3 non-lagging indicators and explain to you how you could maybe use them in your trading or just as a part of your technical analysis in general. And if you're not someone who actively uses technical indicators or already has a good setup, well, I'm sure you're gonna learn something new here, so let's just get right into it. Now, the thing about these non-lagging indicators I'm about to cover is that just because they are leading indicators doesn't necessarily make them better or more useful. In fact, I find that a lot of the time people would just rather stick to regular indicators when they compare the two. It takes a while to grasp this mentally, but when you really break it down, there's not that much difference in accuracy between different indicators. And there will never, ever be a technical indicator that can be followed blindly to make you profits consistently over a long period of time. On that topic, you need to understand that these indicators I'm about to mention, and every indicator ever, should be used as supportive tools for decision making. So the first non-lagging indicator is actually RSI. Many people who say that all indicators lag don't even know that the RSI is a leading indicator, and RSI is actually one of the most popular indicators in the world, built into literally every charting platform. The reason it's considered leading is because it shows divergences between price a lot of the time. For example, when price is going higher and higher, but the relative strength index is actually dropping further and further, this is a real leading indication that the market is due for a reversal. Now, the thing is, just because it's a leading indicator in this way doesn't mean it's some magical tool that's predicting the future. There's always a trade-off, as I explained earlier, with literally every indicator. So in this case, with the RSI being a leading indicator, the trade-off is that even with the relative strength going down and down and the price going up and up, it's about how you time the reversal to make it work. Because the price can go up and up and up further than you think, even if the RSI is dropping more and more. So considering this, you could use the 50 level on the RSI to have more of a confirmation when a reversal is more likely, or you could pair it with support and resistance, market structure, price action in general, etc., etc. The next leading indicator on the list is the Fibonacci retracement. The reason this could be considered a leading indicator is because you can see where price might likely go in the future with it. And there's no lagging calculations to use the Fibonacci retracement tool. You could just create levels by using a swing low and a swing high, and then have an idea that, say, for example, if price goes into the golden pocket zone between 0.618 and 0.5, you'll be looking to buy, which is in itself a leading indication. So that's just a brief example of how something as simple as a Fibonacci retracement tool can be considered a leading indicator in itself. And the next indicator we are going to discuss is called Ichimoku, also known as the Ichimoku cloud. The reason I bring it up now is because the way it's calculated is basically just creating moving averages that are theorized by the creator. However, the way some components, such as the cloud itself, are plotted on the chart can give you some leading indications. The cloud is actually lagging, but it's plotted out into the future in a way where you could get dynamic areas of support or resistance, which in itself is giving leading indications of where the price might go. You can also take, for example, another component of Ichimoku called the Chiku. Even though that some charting platforms call it the lagging span, it technically isn't lagging based on its calculation, and it could still give you some leading indications to use in real time. So the Chiku is just the closing price of each candle, but actually put 26 bars in the past, so it just displays as a line on the chart that interacts with the past price action. And it can even give you some leading indications of trends when it crosses above or below the past price action, or even when it finds resistance on the historical price. You could consider that as an area where the price currently might find resistance. Every other component of Ichimoku that plots in the chart, not referencing any of the other theories behind how it's used, are 100% lagging. I see a lot of people calling it a leading indicator, other people calling it a lagging indicator. So it's an interesting debate, but the real answer is that there are no calculations within the indicator that make it considered leading, but the way it's plotted on the chart could give you some leading indications. Now, I hope that makes sense, but it's probably the best answer you're gonna find on whether the Ichimoku indicator specifically is leading or lagging. So you'll notice a lot of these indicators are just oscillators or components of tools for finding support and resistance levels that you can use out in the future. And the truth is that most indicators do actually lag. And the most usable ones you'll find, like the moving averages, trend following indicators, etc., are not necessarily useless. And in fact, I think that they are more usable than leading indicators. So the only thing that you have to keep in mind and that you should take from this video is that indicators should be used as supportive tools for decision making and never to be followed blindly. Doesn't matter if it's a lagging indicator or a leading indicator, there's never going to be something that you can blindly follow and make money. And that doesn't mean that indicators are completely useless either, because a lot of the time they give you great ideas when it comes to trading and investing, compared to using nothing at all. So if you made it this far into the video, you're probably looking for a better understanding of TA in general. So I recommend watching this video about trend lines that we made right here. And on that note, hope you guys learned something new from this, and I'll see you guys in the next one.